Today is our Q2 2026 Jacksonville Real Estate Market Outlook. It is a special edition that we do on the show once a quarter where we bring the community together, we bring JWB clients together, and Gregg brings in all of his thoughts together in one big presentation to give you a great snapshot of what's happening out there in the real estate market and three big investor takeaways. Welcome everybody to the weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Fantastic to be with you today.
GC, you have been working tirelessly for like 3 weeks to put this thing together. I know that you put a lot of thought into this. As you were getting into this report in particular, talk us through it. Talk us through the experience.
So the preparation that goes into this quarterly report usually starts about, I would say, 4 to 6 weeks before we actually get to show up for game time here today. And it usually is a process of research and then putting it together. And then Pablo and I, we go through those thoughts. We then do dry runs. We make sure that it sounds good, it looks good, it feels good, all these good things. And then I have the opportunity to go and share it to the team. And usually we'll do that about 2 weeks before we actually come here. And usually that is my final dry run because like 80% of what I'm going to share with you is baked in there. This time it was different though. I was sharing with Pablo that I really did 2 separate presentations because 2 or 3 weeks ago when I put this presentation together, I feel like the world was very different then. And it's only been 2 or 3 weeks. So this has been a really, I think the timing for this one is really, really important. And I'm so glad that we're here today because just in the last 2 weeks, there have been big news, big shakeups, geopolitical shakeups that affects our economy substantially, affects interest rates. And this is a great time for us to all come together with all of this new information, and hopefully from my perspective and JWB's lens, we can start to, I think, calm the noise in some places. Mm-hmm. And then there are some places that I want to bring into something that I do think is a little bit of a concern. And so I'm going to do all of that here today. And I hope that we deliver on the promise.
As we were doing our regular run on Tuesday mornings this morning, one of the things that came to mind is we were kind of like discussing a lot of this stuff is that there are some like new insights here, but there's also just like this feeling, GC. I think that when you validate for the community kind of like what we're all thinking or what we're all hearing, and it might not be a new insight, but it's just kind of like, yeah, you agree. There's a certain sense of like calmness, right? Like there's a certain sense of like acceptance of, okay, this is really what's happening. I'm not crazy. Because at the end of the day, the Not Your Average Investor community is exactly that. Mm-hmm. We don't always have the same opinion as the regular media or what's happening out there, but we are all real estate investors and that makes us somewhat weird in a certain way. And it's good to just kind of like come to terms with exactly what's happening in the world and how it's going to affect this man. So I think this is going to be really, really good.
Well, and I think, if I'm in the seat of a client and I put my hard-earned money into this asset class and I'm a little bit not your average, I had to kind of overcome that. I want to make sure that people who have a lot more money invested and their careers invested and their reputation invested, I want to hear what they say because I got to know, they need to know and make sure that they have the best lens because there's a lot more at stake. And so that's really what I want to share with you is what do we see as owners of, hundreds of single family rental properties and with, over $1 billion of management as a responsibility for us to be able to handle. What do we see so that we can better inform you and ultimately give you more confidence? And what is a chaotic time to be living and investing?
We have been through chaotic times before, and we continue to be in chaotic times right now. Let's get into it. GC, we've got about 100 people on the call today. This is awesome. Thank you for making time to be here for the Q2 2026 Jacksonville Real Estate Market Outlook. First things first, this is not financial investing advice. Everybody should do their own due diligence. Your results may vary. What is anything else that I'm missing on that one?
We're not financial advisors. We're just real estate investors. Been doing it for 20 years plus. So here you go.
And speaking of real estate investors doing it for 20 years plus, if you have any questions about this type of stuff, if any, like if you need to talk to somebody on the JWB side, there's a whole team of folks here ready to talk to you about these things and how it affects real estate, how you can plan for your financial future in a way that is less chaotic, find some normalcy, have a good retirement out here. You can call JWB at 904-677-6777. You can text JWB at 904-293-0341, or you can just schedule an appointment, chat with JWB.com. You ready for this, GC?
Let's do it, baby.
Okay, so the world is in chaos. All this stuff is happening. We have 3 takeaways. Let's start with the snapshot. What is going on right here at home in the Jacksonville market?
I think this is a good way to just kind of level set. We do this every quarterly Outlook, the same data, both on the sales side and the rent side. And so that's what I'm sharing with you now. The major theme and the major takeaway here is that this concept of normalization for pricing and rents continues to play out in Jacksonville and across the US. This is the same approach that we have had for years and years and years now, where we predicted that things would normalize. That's what we're seeing here. We have been not playing into the headlines that tend to send you in one direction or another direction. It really has been about normalization. That's what we see playing out. So the median home sales price here in Jacksonville is $350,000. That has led us to home price appreciation of roughly flat, right? About 0.6 negative over the last 12 months. And then what we do is we look at an average of the last 6 months over the last 12 months. And that gets us to right about flat. Our average turnkey home price is about $243,000. Median days on market 52. Months of inventory is 4.1, which we've talked a lot about how months of inventory is a leading indicator of home price appreciation. And so 4.1 is right where we expected it to be. And then foreclosures are almost non-existent, under 2%. And a normal market has 10% of the homes that are selling in foreclosure. So very normal market when I look at what prices are doing here.
Got it. So as I look at this price, this medium single family home price of $350 seemed that's way higher than it was 5 years ago, but it's about the same as it was last year, right? Average JWB turnkey home price, a little bit over $100,000 under that. That shows this idea that the average JWB turnkey home is workforce housing. It serves for the folks in somewhere between 80% to 120% of the median income, and it also shows that there is upside in JWB turnkey homes when you're that much below the median single family home price as well.
Absolutely. We're going to take a look at that in the next slide as well.
Okay, got it. And then months of inventory, we've talked about this like normalization, 6 to 7. We're still below the normal months of inventory, and we're below the Jacksonville foreclosure rate. And to you is a normalized market that behaves like the market behaves over a 20-year span.
Yeah, absolutely.
Got it. Cool. So then let's go to our favorite little chart here, right? Where are we on this median home sales chart versus the home price appreciation?
Yeah, so normalization could be reflected in the numbers that I just shared. It can also be reflected graphically. I think graphically works even better. This is the same chart that I've been sharing with you forever. We just updated quarterly, of course. And what it shows is the blue lines, jagged lines, are the actual median home sales prices. And then the red smooth line is the projected median home sales price. And this concept of normalization is that over time, there are cycles to real estate. And if you believe that real estate is cyclical, which is what the data has proven, you're going to always kind of come back to that normal trend line for growth in your marketplace. And it might be a little bit above the trend line, a little bit below the trend line. You generally don't have large periods of time where you go way above and way below, or you don't have large, in essence, bubbles above the line and then depths below the line. That has been our existence, for the last 20 years. We've seen that. But normalization means that your actual median home sales prices are just kind of riding that line, a little bit above, a little bit below. So when we had predicted that normalization is what we would see in the Jacksonville market and across the country, we're seeing it play out when you look at a chart like this, because our actual median home sales price was slightly above the line, a year ago or whatnot, and then it is now slightly below the line. And so when you mention, hey, is there an opportunity for home prices to go up? Yeah, if you believe that home prices are cyclical and you're below the trend line, you think it's going to get back to the trend line, then yeah, you would believe that there's going to be an increase in home price appreciation at some point over the next market cycle to get you back up to that trend line. And we would believe that.
Makes a lot of sense. So this is the rent data, right? So the first is pricing data. This is now the rent data. Average a single family home is renting at $1,820. Average single family rent price appreciation also relatively flat, 0.2%. Average JWB rent price is $1,535. JWB is right now currently renting 1,500 homes. Is that? Oh, no, no, no. That's, you guys are renting more than 1,500 homes. What is JWB Homes rented?
Well, so that's what we rented over the last 12 months.
That is homes you filled newly over the last 12 months.
Yes,
But
new.
you are, like when I hear rented, I hear that you manage 1,500 homes.
Oh, gotcha.
Right.
No, we
Yeah,
manage
yeah.
over 5,700
Okay,
homes.
got it.
And then, but over the last 12 months, it's been a little over 100 a month is what we have rented.
There you go. And then average JWB rent collection rate is 98.2%, meaning the folks living in these JWB homes are paying their rent on time. And the average early termination / eviction rate is 0.4%, almost non-existent as well. And I'll let you read off this little piece.
Yeah,
here,
we're
JC.
we're very very proud of this. The last quarter I shared with you in the community that we had achieved over 98% rec collection for at least 21 straight months. And then the community said, "Well, Gregg, why is it at least 21 straight months?" And I just kind of leveled with you guys and I was like, I didn't go back and do all of the research to figure out how many months it had been. So for this one I wanted to show up with the research. We've actually had over 98% rent collection for 42 straight months. And those are through some of the toughest times to collect rent, that we've experienced over the last 4 years. So very proud of that. And overall, when you're looking at the rental market in Jacksonville, it's the same word I keep saying, normalization. When you look at rents slightly ticking up, when you look at a lot of homes renting, you look at high rent collection, you look at very low early term and eviction rates. There's a macro sense there that things are working like normal. And then there's a micro sense, meaning that JWB Property Management is delivering on the promises to the investors.
Do you consider this normalization, GC, or is this better than usual performance for you guys?
It's our normal. It's not normal for the property management space as far as 98% rent collection.
True. Sure. All right. That makes sense. We've got a question here from Anonymous ND that says, how is the overbuild of multifamily apartments impacting single family rents and time in market? Is there a market difference in tenant base for both? Any market data around this?
Yeah, great question. Great question. So the data that I'm sharing with you is the single family rent data. If I was to share the multifamily rent data with you, it would tell a slightly different story. It would tell a story where rents have actually decreased year over year in multifamily and apartments. And the reason behind that is because of the overbuilding, the oversupply of multifamily that happened over the last 3 years, roughly. When it was the age of easy money, there was a lot of money flowing around. People wanted to invest in growing markets like Jacksonville. And in multifamily, you can build and build and build hundreds and hundreds and hundreds of units at a time and quickly go from undersupplied to oversupplied. And so for the multifamily space, that's what happened. And they're now absorbing all of those units. A year ago, I think there were 4 to 5% declines in rents specifically for multifamilies. I think now it's somewhere around 2% for a decline for specifically multifamily rents. But that is not single family. Single family is more insulated than multifamily, specifically on the supply conversation. There is an indirect relationship, of course, between single family and multifamily. In essence, if we hadn't had the oversupply of multifamily, single family rents would be even higher. But as we look here today, multifamily rents are slightly positive year over year, and that's what we've seen for the last year or so. And we'll continue to see that, and then we'll continue to see gains, I think, in future years for both single family and multifamily.
Awesome. Great answer. One more question here, GC. We've got somebody in YouTube that's chiming in saying, loves the show, but thinks that these are misleading home price appreciation data because home prices in Jacksonville have dropped 5 to 10% in the last 3 to 4 years, and that 6 months of trailing data numbers can be misleading. Industry standard is year over year. Can you explain that?
I'll take the last point first.
Yeah.
I really like where this person's coming from because they do have an understanding that the best way to analyze a home price appreciation is to look year over year. And that's absolutely what we're doing here. We look year over year for each of those last 6 months, and we take the average of the last 6 months year over year data. What this does in essence is, I think, is more to the point you're trying to make. You're trying to make the point that you just don't go month over month, right? So what this does is you take year over year, and then you average that appreciation rate for the last 6 months. So I hope that point comes across. I'm so glad you asked because I don't normally go in that much in depth as to how we get those numbers.
Yeah.
But it's actually taking the year over year data and smoothing it out to limit the short run, increases. Sometimes month over month, you can actually go way up and go way down. So that was the second point. The first point.
Yeah. What about this idea that home prices in Jacksonville have dropped 5 to 10% in the last 3 to 4 years?
Yeah, I mean, I know the data. I know the data. And so the data doesn't show that. And happy to share all of our sources with you. We go to the multiple listing service, which is where professionals go to actually look at home prices and home price appreciation. We've been tracking this data monthly since 2014. So we'll just, politely disagree on that point.
All right,
If we, there we go.
Cool. Happy to answer the tough questions though, right? So appreciate you chiming in. Screen name is MBA Indian 7642. So maybe
Nice.
somebody local here with an MBA of Indian descent would be my guess. That being said, so that is the Jacksonville snapshot. That's what's happening here in our backyard. Now let's talk about kind of like the overall context of the world and how much that has changed. We've got 3 context changes and 3 takeaways. First one, GC, I think is the obvious one everybody's thinking about. It's the war in Iran. What can you tell us about that?
Man, things changed very quickly. And I think we're all affected very deeply and on a personal level. And so first of all, taking the investor lens out of this, our hearts and thoughts are with everybody who's involved, and especially those who are in harm's way. So first of all, thank you so much to our service people. As I start to now just look at the investor lens, I think what's going on and how it's affecting housing probably makes sense to most of us because we see it being reflected in, at the pump when we go and fill up gas, right? We see that now it's really hard to get gas, advertised for less than $4 a gallon, on its way to $5 a gallon. And every time we pass by the gas stations, it gets worse and worse. And so I thought what I would do is just kind of take an overall look and just kind of talk about what happens during a war with Iran like we are having here, and then how that affects inflation, and then how that affects housing demand. There's a couple of nuances that I want to share as well. But overall here, we've got this war, we've got this conflict. Oil prices are rising. The Strait of Hormuz is largely closed right now, which is sending global shockwaves as far as the cost of energy. When that happens, the cost of gas, transportation, goods all rise. When gas or energy costs go up substantially, it's like a tax on everything in the economy. Yeah. And, really inflation readings, largely are reading, well, what's the increase of cost to everybody? It's another way of saying, well, it's almost like the net effect of a tax. So what's happening is energy costs are going up, inflation is going up. And then what does the Fed do to combat this? The Fed's mandate is to make sure that our inflation does not run too high like it has in years past. So what they do is they keep they keep their Fed funds rates elevated. By doing that, it increased the cost of borrowing for everybody in the country. But what it really does is it starts to really affect the mindset of investors who would be thinking about investing in treasury bonds. Because our long-term mortgage rates are not affected by the Fed directly. It's not like when they lower them or raise them, it's going to affect our long-term mortgage rates. But inflation really affects 10-year treasuries. Because if inflation is going up, people don't want to lend their money as much to the government or to anybody else. And so what happens is inflation starts to rage, the yield on the 10-year treasury goes up, and then investors who are thinking about investing in a 10-year treasury or investing in a mortgage-backed security say, you know what? If the yield for the 10-year treasury is going up, I need more yield on my mortgage-backed security. And we don't want that as investors because we're on the other side. When they say, I want more yield for my mortgage-backed security, to us, what that means is we have to pay a higher interest rate on it. So that's really what's going on in the space. And because people are concerned about inflation and don't know how long this war and conflict may last, people are fearing this inflation effect, and ultimately mortgage rates have really jumped in the last couple of weeks. What this means for housing is that when you have higher elevated mortgage rates, housing demand is suppressed. We all know that higher monthly payments, that means fewer buyers can qualify. And this word of suppressed or suppression is what I want you to keep in your mind. It doesn't eliminate the demand. It just keeps buyers on the sideline longer. And so we don't know how long this war is going to last. We don't know how long inflation is going to be here or what it may rise to. But whether it's in the short run or in the long run, the net effect to all of this will be further demand suppression for housing.
Yeah, yeah, yeah. So this idea of higher interest rates suppresses housing demand is something that we've talked about plenty over the last couple of years. What about the supply? Do you see like this? Does the higher cost of goods and the stuff that's happening in the Strait of Hormuz and stuff like that, is that also affecting on the supply side too?
It is. And this is a little bit of a different take than what everybody is talking about. But not only is demand suppressed, but supply is also slowing.
Yep.
Because we have already been in a situation where we're undersupplied on the single family housing side. But now when rates stay elevated, that's an increased borrowing cost for a builder.
Mm-hmm.
And for a builder, now it's more expensive for them to build a home. But the big thing is they also get kind of hit because they're saying, well, you know what? Sales are still slow. Sales are slow for builders. So they're not going to be in a rush to go and overbuild and correct the supply problem.
Mm-hmm.
So when you have some demand that is suppressed, this is one of the best things about investing in single family rental properties, in my opinion. It's because your risks are mitigated. Because what's also happening is supply is also being suppressed and slowing down. And that's why starts this year versus last year are lower. Depending on how long this conflict may last and how long elevated rates may be here, that would also further suppress supply, which mitigates the risk as far as the effect of housing prices.
Got it. So there's the suppressed demand that is essentially a displaced demand, right? Like we've talked about the Coil effect and how, when people are sitting on the sidelines, there is this like inherent demand. There's people moving to Jacksonville. They're just not buying homes because of the interest rate. Once the interest rate comes back down, they will buy more homes and it'll lead to this like above average home price appreciation. But then there's also like a new wrinkle to this thing, right? Which is a suppressed supply as well. So is that something that we should consider as is that going to exaggerate the coil effect of suppressed demand? Is that like a new wrinkle of like how we consider this?
It could. It depends on how long this conflict goes on and how long energy prices rise.
Yeah.
This is all really new. So I think we're talking in terms of concepts here. Nobody really knows how long this is going to last. But yes, let's just say that it lasted a long time.
Yeah.
And energy costs were really high and inflation got up to 4, 5, 6, 7%. That in essence would not be a good thing for low interest rates. Interest rates to borrow would be higher in that example. And ultimately, builders would build less because there would be slow home sales, and it would be more expensive for them to build. So in essence, they would sit on the sidelines for building inventory, excess inventory as well. So it could. We don't know. What could also happen is this conflict could be over in a week. And if that was the case, then you would see interest rates come right back down largely to where they were before. And this would have been a little blip and would really not be something to start to put into that conversation that you originally started with. We don't know, but I think we're best to be prepared for anything.
Okay. So as a rental property investor, if I'm thinking about this idea of like a short-term risk and a long, like of this stuff happening and then like not knowing how long it's going to go, like how do I internalize this?
I always want to be in a position of strength as a rental property investor. And again, that's one of the reasons that I love this asset class. It's because it performs really well in times of chaos. We have seen this over and over and over again, whether it's COVID, whether it's all of the low interest rates environments. Now we've had high interest rate environment for the last 3 years. This asset class has been really solid. It's because it performs really well, even when times aren't great. I kind of shared like when demand is suppressed, supply is also suppressed, right? That's one way that you're mitigating your risk. The other thing that I wanted to point out for everybody is, in times of high inflation, owning a hard asset and buying it with debt is one of the best things you can do because you win when you own a hard asset and inflation happens. You do that in 2 ways. Number one, when it's a hard asset like a rental property, the growth of the asset is largely linked to inflation. If you look over long periods of time, you'll see that the average growth rate for single family homes is largely tied with the average inflation rate over the economy. So you win when inflation happens because your growth is largely tied to inflation. It's not the same with other asset classes. But the other hidden part of this, and what I hope to get a little bit louder with, I think it's a little bit more of a complex topic, is just talking about how you win when you borrow in times of high inflation. When you buy a hard asset and you borrow and you buy that asset with debt, what you're doing is you're taking out fixed rate debt and you might be paying that back over 3 years. Well, as inflation is higher, you win because you're paying that debt back in less valuable dollars. So the real benefit of how you are in a position of strength is, number one, your risks are mitigated from a rent and a pricing perspective simply because of supply and demand. Over time, your assets should grow with inflation. And then you can really win when you borrow, especially in times of high inflation. And that's what successful rental property investors do.
Sounds like a familiar message of basically making the assumption that if we believe that home prices go up over time, because it's a real asset, and we believe that inflation goes up over time, then rental properties is this like unique place where in the short run, when there is, there may be a demand challenge, but it is at least matched by a supply challenge that kind of like hedges for the pricing of the asset, right? Like the appreciation, depreciation of like the asset you invest in versus other classes that could go more wildly down in moments like this. And then as far as like long term goes, working from a first principle standpoint, if we just assume that inflation is something that's going to continue to happen and we may be going into like an elevated inflation period because of all this, it also keeps up with that because it's coupled towards replacement value and all these different kinds of things. So it's like risk mitigation in the short and long term. Is that essentially the takeaway?
Yeah, risk mitigation, position of strength is the message that I want to share with you all. I don't exactly know what's going to happen in the short run. Nobody does, but I know whichever way this goes, you're going to be in a position of strength, right? You're going to have your risks mitigated by being in a hard asset like single family rental properties. And then, our thinking, and I hope you're thinking when you're investing in single family rental properties, is always long term, full market cycle. We know that whatever happens today does not affect the growth curve. It does not affect the long-term trajectory of this asset. It may even make it stronger when you start to think about inflationary times that could potentially be here for a while.
So the first takeaway from the context change is the Iran war. And the big takeaway as a rental property investor is that this is doing funny things in the economy, namely inflation, interest rates rise with inflation and all this type of stuff. But there's also supply issues that are affecting the suppressed housing demand that comes from the inflationary piece and the high interest rate piece. So we are in a unique asset class where in the short term, single family rentals in workforce housing in a growing market mitigate for that risk that is the short term supply demand piece and the long term inflation piece.
I want to add one more thing though.
Yeah.
This is ripe for some headlines coming out. If inflation is here, if this conflict does last and elevated interest rates are here, you're going to see a lot of headlines that are talking about slow home sales and how home sales this year are down versus last year. Now, I don't know if they're going to be down, but if elevated interest rates are here. So just be on the lookout. I would imagine if this thing continues to last and elevated interest rates are here and that suppresses demand, just make sure that you take a deep breath when you read those headlines. Understand that not just demand is suppressed, but supply is suppressed. And look at the overall pricing of the market. What I would expect is that it'll largely be flat or somewhere there close.
Thank you for that. Excellent. Nuanced question when it comes to this piece, knowing that Jacksonville is a military town, right? Like Jen Filzen, Fairy Godmother, asks, she says she has auto repair shop clients in Washington State that serve military towns and big deployment drops in the city population have the population down by 30%. Regarding deployment in Jacksonville, do we have any numbers around how large deployments will affect our rentals? I know that we have a diverse economy in Jacksonville, but I'm curious if we know how many rentals that JWB manages have military folks and how that could like them leaving at a moment's notice could affect you.
I haven't heard anything. That's an interesting question. I haven't heard about large deployments specifically from Jacksonville. I haven't heard about that and specifically haven't heard from my property management team that there is an outsized number of our military folks that are serving and that have just recently had deployments. So I can ask and get back to you on a future show, but it doesn't seem to be something that is largely affecting our population here in Jacksonville.
Yeah, something I would point out. I mean, she talks about the fact that we have a diverse economy, but auto repair shop clients versus rental home income, one is a consumption thing, the other thing is a flat thing.
Mhm.
Like the other thing is just like a necessity that happens. So I would see how a population drop in a consumption kind of business would affect them, extraordinarily.
Mhm.
The other thing I think about is, don't when people get deployed for something like this, doesn't the government cover their rent so they have a place to come back to?
No.
Oh, okay, I didn't know
No.
that. All right.
No.
Okay.
As an owner and as a property management company, of course you must comply with the military orders, but you're not covered financially in that case.
Okay, good to know. All right. Next context change. The 21st Century Road to Housing Act got it's announced. I honestly don't know that much about this, GC. So what's the situation with the 21st Century Road to Housing Act?
So this is on the heels of a couple of conversations we've had here with the community. I know we did a show that was devoted to this institutional ban of buying single family homes, and a lot of noise. President Trump gave an executive order, I don't know, a few months ago now, and said that he wanted to ban institutions. So then we started to go into the data, and I brought it to everybody here on the show and added some perspective and just shared with you all that, this wasn't something that was really going to materially affect affordability, just simply because institutions don't own a lot of properties. It has been overblown as far as institutions potentially coming in and buying up all the homes in the neighborhoods and all this. It's just hasn't materialized.
I remember that conversation. Yeah.
And what I also added is that they're also not buying right now. I think they're buying about 1% of all the
1%,
homes.
Yep.
So the takeaway was there's a lot of noise here, and I know people feel good about, sticking it to the man, right? And, not having the big institutions be able to buy everything. And I totally understand and I can relate to that. However, it's just not materially going to help affordability. But what I wanted to talk about today is, I guess, maybe bring everybody back up to speed on that thought process. The legislation that has come out on this, not only is it a stance of like, hey, I don't think it's going to materially affect affordability. I'm very concerned that with the state of the legislation right now that's coming out of the Senate, that it will hurt affordability, specifically because of one rule that nobody saw coming in relation to build to rent. So this is a little bit of overview of, there's a lot that's in it. And just to kind of level set with everybody, it was approved in the Senate. It has now gone to the House. The House had a different version than the Senate, and it hasn't been, approved by the House. And it hasn't been approved by President Trump as well. So it still has some room to go here, but one of these rules inside this restriction of institutional investors is very concerning to me, and I hope that you all are concerned as well, because I don't think it's going to have the intended effect that we all want.
Got it. So what's in this thing? There's the increase of housing supply, right? Like I'm just kind of read this slide if you want me to here. Cutting regulatory barriers, streamlining federal programs, expanding local flexibility. There's the restriction of institutional investors, limiting large investors buying homes, targeting firms with 350 plus properties. That's a new context that we were like asking about last night. We talked about in order to prioritize individual home ownership. There's the modernizing of housing programs, updating HUD and financial tools, adapting to project challenges, improving program efficiency, reducing costs of red tape, eliminating outdated regulations. That's something that we've talked about as potentially being good, boosting private development, focus on supply side solutions, which is kind of like what we generally say is the only long-term fix, increase in oversight and accountability, enhancing program monitoring, protecting taxpayer dollars, ensuring measurable results. And then the big picture goal is just like House plus Senate bill combined, address housing shortages, more supply and policy reform. GC, I'm assuming that the piece of it that is concerning to you is the restriction of institutional investors targeting firms with 350 plus properties. Am I right here?
Absolutely.
Okay, tell me more.
Well, so they put some language in, specifically saying an institution is now 350 homes or more. And they're saying if you own over 300, as an institution, if they own over 350 homes, they can no longer purchase any more homes, which to me is not really going to do much one way or another because of this stat here. And this is from John Burns, our research and consulting. There are only 314 investor groups in the entire country that have 350 or more homes. That's 0.7% of all the U.S. single family homes in the entire country. So you're going to restrict activity for those guys, which is okay. That's totally fine. Big picture, it's not going to do a whole lot. But the way that they're restricting that can have very adverse effects, and that's where it goes into this new rule that was thrown in. It all comes down to this 7-year rule. Which is this big issue for institutional investors. What the regulation says is that investors must sell their single family homes within 7 years and only to individual homeowners. And this is a big deal because there used to be, and what we expected if there was legislation that was brought to this, and there used to be an exclusion for the build to rent type of construction. Typically bigger institutions are doing build to rent. Well, build to rent is building. It's adding supply.
Yeah.
And so this 7-year rule also applies to an institution that would be doing build to rent. And that's where I started to get concerned, as well as under other industry experts. John Burns and his team put out this special report, and it was called the Housing Bill That Will Make Affordability Worse, Not Better. And in there, they talked specifically about how this will decrease new construction specifically because of this rule and mandate that you must sell within 7 years, will likely lead to an increase in rents and home prices simply because you are restricting supply. Institutions are the ones that are doing build to rent. If they can't do it because it doesn't make sense to do it, then you're going to ultimately restrict supply that could help with affordability.
Got it.
So, and let me explain a little bit more about the 7-year rule, because it all comes down to money. So these big institutions raise a ton of money, and then they go and they put the money to work in an asset. And here in this asset is they raise a whole bunch of money from long-term pension funds and sovereign funds and other insurance companies and other places that want returns over 10 to 20 years. And that money has gone into build to rent, and that's why there have been hundreds of billions of dollars brought into build to rent. And so the whole premise of an institution here is to serve that investor base. That investor base wants returns in 10 to 20 years. So the money that is going towards this space will not comply. The long-term returns are expected to be there between 10 to 20 years. It's not 7-year capital.
Got it.
And so if you restrict and say this institution has to be in and out of this project in 7 years, that money source is a completely different money source.
Yeah.
It's a much more expensive money source
Yeah.
for the institution. And ultimately, it would bring a lot of risk to the business model for anybody who does build to rent. Like JWB does build to rent, right? It would bring a lot of risk to the model because I can't always guarantee that the product that we build and then rent out is going to be sold to an individual homeowner in 7 years. I mean, we care deeply about our residents becoming mortgage ready and ready to buy, but sometimes it takes longer than 7 years. Sometimes they're ready at year 5, they go under contract to buy a home, and then they miss something on their credit, and then it takes them 3 more years to get back to being mortgage ready again. So a lot of risk to the model now comes into place, and the capital source that was funding it is no longer interested because they have different goals. And so ultimately, that's why John Burns, and I hope you all see it as something that can have large adverse effects to what the original intention here, which is to increase affordability. I think we all want to increase affordability. This 7-year rule hopefully does not make it into the legislation.
But you see, if you guys build to rent and then you sell it to me, who only has 6 doors, right? Like, does that still count against your 350 doors? Like, aren't you guys bringing to market doors that then go to people that aren't institutional investors?
Well, yeah, but I can't do that. I can't. So let me make sure I'm understanding your question. You're saying this legislation gets passed. JWB owns over 350 doors. So now we're classified as an institutional investor. And we wanted to continue to buy a lot, build a house on it, sell it to you. Would that be possible?
Yeah.
Not if we have over 350 doors. Because now this rule is saying in 7 years, I have to sell it as JWB. I have to sell it to a homeowner, an individual homeowner, to live in the home.
So even if you build that home and you sell it to me as an investor,
right,
7 years later, you still have to sell that to an individual homeowner?
Well, no, but that I would have to sell it to the individual homeowner who's going to live in it. So me selling it to you does not comply.
Oh, so if it's built to rent, no matter who ends up buying it when they comply, it still needs to go to an individual homeowner in 7 years?
Uh, I, I can't sell it to you. I have to sell it to an individual
Okay, but
homeowner
this is
within 7
decreed
years.
that anything built to rent just needs to go,
Yeah.
period.
Yeah. The way it's written right
Interesting.
now. Now, this could change,
Yeah,
but you can kind of see how
yeah,
this is just going to
yeah, that's
totally
crazy.
eliminate a lot of the build to rent model, the way it's built,
Yeah,
right?
yeah,
The way it's constructed right now.
yeah.
Build to rent is sold to other institutions
Hmm.
and other individuals who want to
Yeah.
invest as a mom and pop home investor. Well, neither of that would comply with the way that it's built out right now in this
Wow.
legislation. So I really, really hope that this 7 year rule doesn't make it into the legislation. If the rest of it happens and they eliminated the 7 year rule, then I think there's some pros and some cons. Sure, whatever. You can limit 350.
Yeah.
It really doesn't matter. It's not going to have a huge impact.
Yeah.
But we need to be able to make build to rent something that can raise capital and that can be delivered, that institutions want to be excited about. And with the 7 year rule, that doesn't happen.
Yeah, seems like misguided legislation. What I'm taking away from here essentially is this thing has an intent to try to increase the housing supply. It's really its intent is to bring affordability into check, right? And make it easier for the average American to be able to afford a home. And it seems to be have a handful of things that may or may not help with that, like the red tape and things of the sort. We talked about this idea of changing zoning laws to reduce parking
Right.
things in order to be able to bring more homes to market, increase densities, things like that. That would be good. But within it, there's this idea of going after institutional ownership, which is a very small share of a very, very big market. But that small share are people that are some of the ones that are really, really moving the needle on the supply piece,
Exactly.
which at the end of the day is the one thing that's going to like really increase affordability beyond just regulation changes. And what they're proposing is that anybody that's building to rent needs to sell it to an individual homeowner within 7 years of building that, which will greatly limit how much build to rent happens, which limits the supply. And while most build to rent residences are like are built for renters that prefer renting because they prefer the convenient lifestyle of that, forcing the market to now sell this into the single family home environment is going to essentially cut off the supply that has been the one thing kind of like bolstering
Yeah.
this
I mean,
the asset class and
last
keeping it in check.
last year, JWB built, I believe, 331 homes. If you fast forwarded years in the future after this legislation was passed,
Yeah.
JWB would not be allowed to build those 331 homes and add that supply. We wouldn't be able to sell it to you as an investor. So you can just wipe out those 331 homes of supply.
Yeah.
Plus, we're a very small, quote unquote, institution, right? And others can have a much more dramatic effect on build to rent than JWB can. So let's hope that doesn't happen.
Let's hope it doesn't happen. All right, GC. So then that is context change number two, takeaway number two. Context change number three, I feel like this is something that happens every first, like every
This
like
is my favorite part.
this one we've lived before. And it's this idea that during the first quarter of the year, you're going to see real estate headlines that are super doom and gloom. Tell me more about this one, GC.
Happens every year like clockwork, right? And these were especially doomy and gloomy from some of the most respected names that we know in the media. Wall Street Journal, Reuters, all talking about home sales dropping to more than a 2 year low. And largely these headlines came out around January. The AP saying U.S. home sales fell sharply in January, even as mortgage rates climbed or continued to ease. This was obviously prior to than the last 2 weeks.
Yeah.
But the problem here is that these headlines have one consistent problem. They only talk about month over month data. That's why my friend who asked a really good question earlier, I said he or she really knows something because you must look larger and farther and have more perspective. You need to look year over year. Well, these headlines reflect month over month data. So I said, okay, well, let's look into the month over month data and see, see what the data that you're pulling, see if we can recreate their story of whoever was writing this article, brought it to their boss and said, this is going to be a good article to write. And you can find that if that's what you're looking for and if you lack the perspective here. So here's Jacksonville's month over month data from December of 2025 to January of 2026. Let's see if this feels like a noteworthy article to write. Home sales dropped 36% in 1 month. Oh my gosh. Inventory went up 6%. Look at months of inventory. It went from 3.6 to 6 months of inventory. That's a 67% increase. Oh my gosh, right? And then of course, median home sales prices went down 4%. I mean, that is like the
Pick a headline.
It's not the trifecta. What are the betting folks? What's when you get 4 in a row? Is that
the
quadrilateral?
I don't know.
Quadrilateral.
You're clearly a gambling. Yeah.
So, if you want
Tetrafecta, says Daniel Durant. Thank you, Daniel.
Tetrafecta. All right.
Yeah, good stuff. Tetrafecta.
So, obviously I'm playing this up a little bit, but you could see how somebody who doesn't have perspective and understand that you shouldn't analyze real estate month over month, and you definitely shouldn't analyze it December to January. Why should you not? If you were going to miss the analysis here, why would December to January be the worst time to do that?
Nobody moves during Christmas. Nobody wants to sell their home during Christmas or buy a home or like go through that.
Exactly.
Yeah.
Exactly. So on the decision-making side, people don't want to be thinking about buying a home as much as they do at other times in the year. So the decision-making slows down. Here's the other side of it though. You speed up the closings because your CPA tells you should close before the end of the year. All of the mortgage professionals want to get their numbers in before the end of the year to hit their bonus.
Yeah.
Agents, right? Title companies, everybody is pushing. They push at the end of every quarter, but they definitely push at the end of the year. So like clockwork, every December you have a ton of sales. And then what happens in January?
Everybody chills. Everybody takes a deep breath.
Well, people start to make decisions in January, but it takes 60 days for that to work through the timeline. So in January is when sales slow because nobody was making decisions 30 to 45 days earlier. So you don't have those closings. And then you also are coming from a really high number in December, which makes January look worse. So that is the real story behind these headlines. And then I said, okay, well, let's actually look at this the right way. Let's look year over year and let's see if it tells a different story. And what do you know? It does. So if you look year over year, January 2025 to January 2026, you see a much different story. Home sales actually increased 2%. Inventory actually went down 8%. Months of inventory actually went down 10%. And then home prices actually went slightly up. Is that a little bit of a different narrative or a different data set?
I would say that I would like for sales to increase, inventory to go down, months of inventory to go down, and the median home price to increase if I'm like holding inventory. Yeah, for sure.
Didn't read any articles that said that, did you?
Didn't read any articles that said this.
No. This is boring, by the way. This is boring. This is not good headlines. And so that's why you got to show up here to get the data perspective with a boring take. You know me. That's probably what you're going to get.
For sure.
And this happens every year. This is the effect of what we call seasonality. It is here in real estate for sure. It is, and I always like to talk about concepts, but also show graphically what I mean. Seasonality to me means like the EKG effect, right? So you've got like this up, if you're looking at the blue lines, it goes way up, and then it goes down. Right. And then if you go back, a year before that time span, it went up and it went down. And then you go a year before, it's the same kind of time limit, and then went up and then down. And it's every single year with the exception of, 2020 to 2023, because the world was crazy at that point. And there was no months of inventory at that time. So we'll just put that as an outlier. Right. But before that, right, it's the EKG effect. That's seasonality. That's why every December to January, you could write an article about home sales going down and that home prices probably went down and that inventory probably went up and months of inventory spiked. So it's not worthy of the digital paper that, that those articles are written on digital paper, right? Like people are just misguided when they're talking about home sales crashing, specifically month over month data. It's just a sign for you. If it's month over month, don't pay any attention to it. Go year over year.
Yeah. So always ask month over month, always go to year over year with the data so that you can make the great decisions like the people in our community that have been doing it time over time. That's why we have over $480 million worth of equity within the JWB investor community.
How about that? $480 million just by following this boring, repeatable process, staying with your feet firmly planted on the ground amidst all this noise over the last 20 years. By following that process, you're going to be just fine.
Over normalized time.
over normalized time.
Yeah.
Yeah, absolutely. If you go that far along, right, it has largely normalized, right? Home price appreciation's right around 5%. So we're just going to continue to keep our feet on the ground in front of us, one step forward at a time, and follow the model.
Love it. So GC, what are your market predictions?
Well, so I thought this time we've always made our market predictions and we share them at the beginning of every year. But then I realized that I didn't keep you guys updated on those. So I said, well, let's create a little bit of an accountability measurement here. So I'm going to start to share these with you quarter over quarter and tell you how we stacked up. So these were our predictions as far as interest rates, home price appreciation, months of inventory, and rent price appreciation for the year 2026. And then here's where we are. For interest rates, we expected interest rates to average between the high fives and 6.2%. Where we are today, the average interest rate so far this year is 6.1%. Little caveat, it's higher today just because it spiked in the last 2 weeks.
Sure.
But what we were predicting was the average interest rate. So I'll continue to keep you updated there. About 6.1%, so we're on the high side of that right now. Home price appreciation year over year is actually flat. And this is another further example of the difference between the 6-month smoothing effect versus what year over year home price appreciation is. Last February to this February, home prices are exactly flat.
Okay.
But I smoothed it out over the previous 6 months. So anyway, so we're flat, which is, we said slightly positive up to a max of 3%. So we're right in the mix there. Months of inventory, we expect it to be between 4 to 6 months. That's where we are right now. And then rent price appreciation, we expect it slightly positive up to a max of 3%. And that's right where we are as well.
Pretty good, GC. Not too bad. Not too bad on your record here. It looks like you're kind of like within margin of error of being basically right on all this type of stuff.
We'll see. It's still early on. The world can be crazy. I did give the caveat that you never know what type of chaos is bound to happen in the world and what that could do to interest rates and whatnot. And so we are seeing that play out right now.
We are in black swan territory.
We could be right through this conversation today. We know how to handle it. If that's the case, there may be some short-term disruptions. I may be off on a quarter here and there, depending on how chaotic it is. But hopefully that doesn't transpire, and hopefully we're right there where we expect to be.
And we will keep you accountable. So your 3 investor takeaways for this quarter with these context changes: the war in Iran may cause housing challenges in the short run with higher interest rates and uncertainty suppressing demand, but low supply today, constrained supply going forward, and inflation will lead to increased growth in the long run, proving out that single-family rental properties are the ultimate kind of like resilient asset class.
Well said.
Second takeaway, new housing affordability bill will have little impact on institutional ownership today, but the legislation risks reducing housing supply, disrupting capital, and hurting affordability instead of helping it. Gee.
Couldn't have said it better myself.
Right. Right your people. Tell them they're going the wrong way. And then the last one is our usual Q1 kind of like takeaway here. Jacksonville real estate market. Actually, no, this is different. Sorry, I was assuming I knew what it says. It's continuing to normalize. And that's all we need as investors. Buy and hold investors who invest with the right operator are in a position of strength. Sounds like stay the course, JC.
Yeah. And this last little point here, that's all we need for investors. I wanted to make sure people hear that, right? All we need for this asset class is normalization. Normalization gets you to those financial outcomes. Normalization hits every one of those pro formas that we have.
Yeah.
All we need is normalization. I think for all of us, people have been conditioned over the last 5 years for it to be the greatest thing in the world because interest rates were so low, or they've been conditioned that it's somehow going to fall off a cliff. And that's just not how it goes. It just performs normally, even when the world tends to be on fire. So all we need is normalization. That's what we're seeing, and that is what we expect to see.
I agree. Jen Phils and Fairy Godmother says in the chat, we're in good shape, JWB family. I feel the same way, man. I just can't think of, as you know, like I'm in kind of like a golden season of my earning years, right? Like that's just real talk, right?
Yeah.
Like the last 3 years in a row, Martha and I's income has increased more and more. And like we're making more than we've ever made. I'm at the point where I can make like these like big investment decisions every single year. And it's
pretty sweet, man.
You saw it when it wasn't like that.
Yeah, I did.
As I just kind of like analyze the landscape of like, I've got this pile of money here. What do I do with it? It's really hard to talk myself into anything that makes me feel more at ease than this idea of like workforce housing in a growing market that like it's obvious that it's becoming this like city that's still underpriced and is still, like it's still recruiting people, it has all the things with somebody that I know, I trust, that operates at a really, really high level in a way that's extraordinary to their industry. And on top of that, has like a high degree of accountability of like doing this kind of thing, man. So like, I just don't know what else you would do with your money. If you keep it in the bank, you're going to suffer from inflation, and then every other asset class honestly scares the crap out of me.
Yeah. I think right now people are largely scared. And, in times of being scared, I think there is a premium for something that you understand
Yeah.
and with people that you trust.
Yeah.
And, you have that, with JWB. So
Yeah.
Appreciate that, man.
Yeah, no, just real talk, man. So anybody that wants to get on the phone with JWB, you can call 904-677-6777. Text only 904-293-0341. Schedule an appointment at chatwithjwb.com. I want to give a shout out to the community. We have over 110 people here right now.
Man, that's huge.
An hour in on a Tuesday, taking time out of your day to get educated, see what's going on, make good investment decisions, see beyond the headlines. And this whole thing doesn't happen. Like these reports, the effort that you put into it doesn't happen without the positive signals of the community, of y'all showing up, having these great conversations. I see people exchanging phone numbers in the chat, right? Like the chat is where it's at here. This is where you make friends. This is where you validate your opinions beyond the guy that runs the business, beyond the guy that like hosts the podcast. You get to really, really connect with each other. So really inspired by everybody showing up. We have a bunch of questions, but next week, what we're going to do is we're diving into, like we talked about high level of the Iran war. We're going to give a little bit more context, right? Like we're going to talk about not just what's going on in the Iran war. We're going to talk historical perspective of like how housing behaves during times of war, and we're going to go into these questions. We've got 9 questions
Perfect.
that we can field next week as well. And if there's any other headlines that happen, we're going to do a not your average insights show. So pumped to see you all next week. Thanks for coming to this, GC. Great job with this report today.
Thanks, man. It's been a blast. I appreciate all of you being here. This is our best attendance in quite a while. So thank you guys for being here. And hope you continue to show up next week, and then hope you make a special date to be here, especially every quarterly market outlook as well.
Yeah, let's do it, GC. So you have 3 big takeaways, but like, is there any advice that you have to give to everybody at the end of the show?
Don't be average.